Imagine waking up one morning and discovering that the global machine powering the US dollar, international trade, and modern banking has silently stalled, not by war, not by a financial crash, not by a political collapse, but by a single decision made quietly in boardrooms from Beijing to Riyadh to Tokyo. We're done buying US debt. For decades, the world has depended on US Treasury bonds the way the human body depends on oxygen. They sit at the core of pensions, global reserves, insurance funds, corporate portfolios, and central banks from every continent. They're supposed to be the safest asset in human history. But what if that belief suddenly cracks? What if the world's biggest economies stop purchasing the very thing that keeps America's system alive? This isn't a hypothetical question. It's a pressure building behind the scenes, quietly influencing interest rates, geopolitical alliances, global trade, and the future of every currency on Earth. And it leads to a deeper mystery. What really happens when the buyer of last resort, the world, simply walks away? Before we answer that question, we need to rewind, not just a few years, but decades back to the system that made US debt the crown jewel of global finance. Because the truth is simple. The world doesn't buy US debt because it trusts America. The world buys US debt because it needs the dollar machine to function. Every trade between two countries, oil shipments, semiconductor sales, wheat contracts, cargo shipping, cross-border investments, relies on dollars. And those dollars, they flow from one source. The US government prints dollars. US Treasuries absorb dollars. Foreign nations reinvest those dollars back into Treasuries. The cycle repeats, creating what some economists call the dollar recycling loop. It's efficient, it's predictable, but it's also fragile, and it has a breaking point. To understand why, let's go back to where this loop actually began. The modern US debt ecosystem began in 1944. At Bretton Woods, the world was rebuilding after World War II. Nations were broke, currencies were unstable, and international trade had collapsed. In that chaos, the US stepped forward with the world's strongest currency, the world's largest gold reserves, and the only industrial economy left fully intact. So the world made an agreement. The US dollar would become the anchor of global finance. Other currencies would be pegged to it. And the US promised every dollar could be exchanged for gold. This was the first contract binding nations to American debt, indirectly at first, but permanently over time. Then came 1971. President Nixon ended the gold standard. Suddenly, the dollar wasn't backed by gold. It was backed by trust. And for the first time, US debt became the world's collateral. If a country wanted dollars, it bought US Treasuries. If a corporation wanted stability, it bought Treasuries. If a central bank wanted reserves, it bought Treasuries. The United States gained something no empire in history ever controlled. The global right to issue debt that everyone else needed. And that privilege reshaped the world economy. By the 1980s, this system exploded in size. Countries that exported goods to America, Japan, South Korea, China later on, ended up holding massive piles of US dollars. What did they do with those dollars? They recycled them back into US Treasuries. This did three things simultaneously. 1. It kept US interest rates low. The more global buyers there were, the cheaper it was for America to borrow. 2. It strengthened the dollar. Global demand turned US currency into a global commodity. 3. It allowed the US to run massive deficits without consequences. In any other country, this would collapse the currency. In America's case, it became a superpower advantage. Over time, the world built deeper layers onto this system. The petrodollar agreement with Saudi Arabia, insurance companies buying treasuries as risk-free assets, pension funds using them as long-term guarantees, foreign central banks using them as currency reserves, corporations using them as collateral for global trade. By the 2000s, US debt wasn't just an asset, it was the backbone of global finance, a single, unstoppable loop. America prints dollars, gives world, receives, dollars gives world, buys US debt, gives America, prints more dollars. But every system with a feedback loop eventually hits a limit, and around 2010, the cracks started showing. There wasn't one event, but a sequence of shifts. Each subtle, each ignored, each more important than the last. For years, China was the largest foreign buyer of US debt. Then it stopped, not suddenly, but consistently. It began selling treasuries, diversifying reserves, and building alternative trade pipelines outside the dollar system. This was the first major sign. Saudi Arabia, once the rock-solid pillar of the petrodollar, began accepting other currencies for oil. This wasn't a full break, but it poked a hole in the foundation. Japan, historically a huge buyer of US Treasuries, needed to defend its own currency. To stabilize the yen, it began selling Treasuries instead of buying more. When inflation surged after 2020, countries needed money at home. They weren't going to fund American deficits at cheap interest anymore. Suddenly, US debt wasn't the easy sell it used to be. The buyers were backing away slowly, but unmistakably. And the US government had a decision: attract buyers by raising interest rates or print even more money to cover the gap. It tried a mix of both, but both paths have consequences. And neither solves the deeper issue. What happens when the world stops absorbing trillions of dollars of US debt each year? Let's explore that next. Here's the chain reaction. If foreign buyers step back, the US must lure new buyers with higher yields. That means higher mortgage rates, higher government borrowing costs, higher credit card interest, higher corporate borrowing costs. The US economy becomes more expensive across the board. If foreign nations aren't buying treasuries, they're also not holding as many dollars. The global demand for dollars drops. That means a weaker dollar, more expensive imports, rising inflation inside the US. This affects everything Americans buy, from fuel to food to electronics. Right now, interest payments are already one of the largest government expenses. If interest rates climb because buyers disappear, the US faces a brutal reality. It must borrow more money just to pay interest on the money it already borrowed. This is the beginning of a debt spiral. Treasuries are the world's risk-free asset. If confidence breaks, pension funds panic, banks tighten lending, emerging markets collapse, global trade contracts, currencies swing violently. This isn't a US problem. It becomes a global reset. Countries already building alternatives, BRICS+, Gulf nations, Southeast Asia, accelerate efforts to escape US financial control. This leads to non-dollar trade zones, new regional currency coalitions, new debt markets, new alliances, fractures in NATO and Western unity. The world shifts from dollar-dominant to multipolar. And that brings us to a hidden truth. If the world stops buying us debt, the world changes as much as America, maybe even more. Because everything today runs on the assumption the US always finds buyers. The world always holds treasuries. The dollar always remains king, but assumptions don't last forever. Especially when the players are already planning their exit. The US isn't powerless, but every fix has a cost. Higher yields attract buyers, but they crush the US economy. Mortgage rates would jump, businesses stop borrowing, jobs disappear, recession deepens. This keeps the government funded, but it risks inflation or even hyperinflation. Money printing is a pressure valve that eventually breaks. This has been done historically in other countries too, but it drains liquidity from stocks, real estate, and private investment. It slows economic growth. In theory, this helps. In reality, it never happens. Cutting spending means reducing military budgets, cutting social security, shrinking healthcare programs. No government willingly dismantles its own political survival tools, raise taxes, collect more revenue. But Americans are already stretched, and higher taxes can't cover multi-trillion-dollar deficits. This is the unspoken last resort. Inflate away the real value of debt. Redefine obligations. Extend maturities. Change the rules. It wouldn't be called a default, but the result is the same. The government pays back less than it borrowed in real value. Every empire has faced the same moment. Rome debased its currency. Britain drained its empire to fund wars. Spain collapsed under silver-fueled inflation. France defaulted multiple times before revolution. The Soviet Union failed to sustain its fiscal burden, and each time the pattern was identical. Overspending gives dependency, gives debt surge, gives foreign buyers retreat, gives collapse or reinvention. Right now, US debt is climbing faster than at any other moment in history. Debt growth is outpacing GDP. Interest payments exceed the military budget. Foreign buyers are holding the smallest share of treasuries in decades. These aren't signs of collapse. These are signs of transition, a shift from one era of global finance to another. The old model, the dollar recycling loop, is aging. What comes next is uncertain, but the three clear takeaways. Takeaway 1. The world doesn't need to fully stop buying us debt to trigger consequences. Even a slow decline in foreign demand pushes interest rates higher and strains the system. Takeaway 2. The US debt machine relies on global trust, not strength. Once trust erodes, alternatives begin to form rapidly. Takeaway 3. A shift away from US debt is not a collapse, it's a transition. But transitions are painful, and financial systems never change without turbulence. Every empire in history believed its financial system was eternal. Every one of them was wrong. What we're re-witnessing now isn't a sudden crash or an overnight disaster. It's the slow turning of a wheel that hasn't moved in 80 years. The question isn't, will the world stop buying US debt? The real question is, what replaces the system when it finally does? Because a world without a dominant US debt market won't look familiar. It will be something entirely new. If you found this breakdown valuable, make sure you like the video so it spreads to others who need to understand what's coming. Subscribe for deep dive economic history, global finance breakdowns, and the hidden mechanics shaping tomorrow's world. And in the comments, tell me, do you think the world will move past us debt, or will the system find a way to survive? But the pressure is unmistakable.